Everybody, David, what's up? Shadow Guy, Ha- Hades, Hades. Yeah, I'm working on Coinbase right now. The video on Coinbase,
Cool.
and it's exactly correlated to Bitcoin. If you look at the price of Bitcoin, the price of Coinbase, they move pretty much almost exactly.
I agree with you. And one of the things that Coinbase is somewhat unique and valuable is that they generate free cash flow. It's seldom that
Yeah,
you see a new business in a new market create free cash flow, but they do. And they're what I like. So finish your thoughts, because there's a lot that I like on Coinbase, but I want you to finish your thought.
No, it's a company that generates revenue and profits. Coinbase is a currency, just like any commodity. Gold has no value unless you turn it into something like jewelry or use it in use it like part of like building a car or people. So I think it's in dental procedures. So yeah, so it's definitely, if you want exposure to crypto, I think Coinbase is a better alternative than Bitcoin.
Yeah, and I'll tell you, I know that primarily we're stock investors, and my investing in cryptocurrencies, I kind of, you use the analogy, I dipped a toe. I dipped a toenail and then I dipped a toe. I was very careful, but I'll tell you a quick story personally, and then how I think the digital world is really, it's pretty much something we're a part of. So cryptocurrencies are digital. It's digital money. It's digital gold. Okay. And the concept of it is no government controls Bitcoin. It's a decentralized currency, similar to gold. Like gold, you can sell it in China, you can sell it in Saudi Arabia, you can sell it in the UK, you can sell it in the US, you can sell it in Mexico, Australia.
Mm-hmm.
It's a universal commodity. So is Bitcoin, except it's digital, and you can send it to anybody on earth at the speed of light. It's pretty transportable. Having said that, my wife was telling me, like, we have two sons. One's about to be 20 on August 10th, and the other one's 24. The 24-year-old grew up playing this game. It was called Animal Crossings, and he's a 3-4-year-old that's in a make-believe world where you're actually taking care of your home and you're taking care of your community. And he invited us to play with him, and he would get on our case because our homes, we wouldn't go in the game as often as he would. And it was a really neat experience for him. So at 3-4 years old, this kid was already submersed in the digital world. Okay. Everything else, Facebook, we're doing a live stream globally. It's totally digital, but we still use currencies that were created thousands of years ago. We use a system that was created thousands of years ago, and we try to port it into a very modern world that's fully digital. Well, with cryptocurrencies, you don't have to port anything. It's there. It's fully digital, transportable. It's ready to go. And if you look at, like, the oil industry is going to convert barrels of oil into a equivalent crypto unit of measure. And then you'll be able to transact a barrel of oil without any government saying, well, I think it's $85 a barrel, dollars. Or the people in the UK say, well, it's this much in our currency, and people in China say something else. No, it's a barrel of oil. It's a unit of measure on a digital format, maybe in a blockchain, in that world. So as we look at Coinbase, yeah, this is like really, it's a little bit like AI, right? We don't really know how big AI is going to be. How intrusive is it going to be? Are we really going to have robots in our homes doing the dishes, and vacuuming the house? I don't know. I don't know how far it's going to go. It's same thing with cryptocurrencies. I don't know how far it's going to go, but I know it's big, and I know it continues to expand, and Coinbase continues to expand with it. So I made a bet on Coinbase. It's really worked out. I
Yeah.
didn't make a big bet, and we'll see how it goes.
Yeah, I remember you telling me you bought it, and yeah, it's doing well. So yeah, that was a good investment. But obviously no one knows. I just watched a video this morning, and I shared it on my channel about Bezos in 1999 talking about Amazon. It's just amazing, like the vision he had. Like he nailed it perfectly. He's like, this internet thing we know is going to be big, but we don't know which handful of companies that are going to explode from it. If you look at the 1980s, which companies benefited from this, and then but he was one of the companies that exploded from it, and you just don't know. Same thing with AI, same thing with anything. If it's a new technology, a new product, we know. I mean, certain things will obviously don't make it. They become obsolete. But other things just like EVs, like who knows? It actually was doing really well, and now there's a pullback. Are EVs going away? No, they're not going away, but maybe they're not as they're not going to be as popular as we thought. Maybe it'll take longer.
And there's a lot of competition. Like all the legacy car companies jumped in, brought their EVs to market. You have Tesla, you have Rivian, you have the new generation car companies. So the competition, I think, is what's driving down prices. Tesla has been having to lower their prices. I know you can get a good deal on an EV right now.
Yeah. When you have companies like Toyota, Honda, these companies have a long history and money. It's tough.
Yeah, I agree. Let's talk about a couple of things. N Kiter, thanks for joining. It's 10 p.m. where N Kiter is at. So thanks for joining. And we have a couple of requests already. We're going to go over Lumen, and we're going to start with the sell-off. We had a pretty good sell-off this week, and the volatility has been really high. I wanted to get your take, Scott, on the sell-off, any kind of big picture things you're seeing, and more importantly, where do you see the market going next week and for the remainder of August?
Well, the trend is your friend, or the trend is your worst enemy. So things tend to trend. So in the short term, it seems like things are trending down, and I wouldn't be surprised if the pullback continued, because it was amazing first half of 2024. I benefited a ton because I'm in tech pretty heavy, and also 2023 wasn't so bad either. So there's going to be pullbacks, but the fundamentals are there. Like these companies that are reporting amazing numbers. I mean, the big ones like the Meta, Amazon, Apple, Nvidia, they're dragging the market up because they're just so huge of companies. But they all have really good numbers. I think all of them beat revenue for the second quarter. I think only a handful beat their earnings forecast.
I got a report ready for you. Check out this report. Over 80% of companies that reported earnings this week beat profit estimates.
I mean, there you go. I mean, the numbers don't lie. Like people keep saying, "Are you worried about a recession? Are you worried about?" I would be worried if it was like it was in 2001 or 2007. But the numbers are just so strong, and we're not just investing on like fake, like the .com. It was kind of like there was no profits there. So people were investing on these companies that aren't even doing anything, but the potential of them doing something. But that's not happening now. We're really in a strong economy. But there's always going to be pullbacks. I think if you're a long-term investor, just keep buying. I don't see that much of a risk. I'm not too worried. I mean, I have my own theory on now that we'll never ever hit a recession ever again. A long-standing recession. We'll never hit one ever again. We're just too strong of economy now. Future recessions will be short, like it was with COVID. A few weeks, but we're not going to hit. There won't be like a 2-year recession like it was in 2008 or 2001, or decade recession like it was in the 30s. I don't think it'll ever happen again.
I agree with you that. So it's not the subprime mortgage meltdown, which it had a couple of big, I'm going to say collateral damage kind of items. So that one was big, especially some industries saw huge layoffs, right? Just ask Lehman Brothers employees. They all lost their jobs. And then the dot-com bubble, also that was a significant pullback because there was just so many fake companies. But this one here, now, is a recession possible? My answer is yes. It would be possible. Is it going to be a deep recession? No. I think it'll be we slow down. Okay, we get it together, and then we take off. I was gonna, and there's something different between the dot-com bubble and now. Okay, there is something significant. The GPU demand from NVIDIA, and I saw this report. I forgot which YouTuber was showing it, but basically the biggest buyer is AWS. Number 2 is Microsoft, which is Azure. Number 3 is Google with their hyperscaler business. And I think Meta is number 2 or number 3. So those 4 make up close to 40% of GPU purchases. So that's a big difference from .com. Those 4 companies are brilliant. They really know what they're doing, and they might be taking a chance buying these GPUs. The other thing too is they got more money than they know what to do with. So they got plenty of cash. It's not like, oh no, Meta is going to have to take a, short-term loan. No, they got so much cash on their balance sheets. No big deal. So it is kind of like, hey, these really smart companies are buying the GPUs. I still think NVIDIA is overpriced because very quickly it's those 4 companies. If they see like, hey, AI is not working, they will turn off the faucet like that. So we'll see. So I agree with you. The recession, if it happens, it's not going to be that bad. We may end up not having a recession. I think about 2 years ago, it kind of got annoying. Yeah. We heard a recession's coming, like Chicken Little, right? The sky is falling, and it never came.
But that's the worst part of anything. Like if you ever worked at a big corporation and they do mass layoffs, say, I remember in the Great Recession, they were doing mass layoffs. The most stressful part is not getting laid off. The most stressful part is thinking about getting laid off and every day talking about it with everybody else and saying, oh my God, what am I going to do if I get laid off? But if you actually get laid off, it's not, you move forward. You're not going to jump over a bridge. You move forward, you adapt. Sometimes it turns out better. Same thing. When there is a recession, they always say, we've been in a recession for 2 years now. Now it's coming to an end. We're like, oh, it was? I didn't even know we were in a recession. So I don't know. I mean, are we technically what's the definition of recession is like
GDP goes negative for 2 consecutive quarters.
Yeah, which happens sometimes, and we don't. It's never going to be like the Great Depression where so you're on the streets and you can't eat. That was pretty severe. Job loss was huge, things like that. It'll never get like that. Like we're just too evolved as a society. But that's what you hear in the news. I heard it like from 2000, after the Great Recession. Then it took us a couple of years, I think, to bounce back. But then, so from like 2011 to 2018, like for 7 straight years, it was like the world's coming to an end. We can't have these 0% interest rates. Something's going to blow up, and that's all you heard. But the market went up so much, And if you listen to that fear, you don't benefit from all that growth.
So right now we're sitting at 2.8% growth in the second quarter of 2024, GDP growth. That's pretty good growth. You're not breaking any records, but 2.8% is good. Now,
Yeah.
Are we going to go negative? It's going to take a lot to go negative. I mean, 2.8 is pretty good. It's not like we're at 0.5 and it's like, yeah, we're pretty close to a recession. So we'll see. All right. So let me switch gears and let's take a look at sectors that did poorly. Technology, but of course, over the past year, it's been number one. Over the past 3 years, it's been number one. So let's not forget that. But the number one sector was real estate. The lowering of interest rates really benefited in real estate. Utilities had a great month. Healthcare had a good month, and consumer staples, which is a usual suspect when you hear recession rumors. Any thoughts on which sector you're like keeping an eye on where there might be good buys going forward?
So it's interesting. Like when I was getting hit hard, Meta was my worst. But I was getting hit not just most of my tech stocks, like in 21 and 22, tech stock were getting killed. But the staples like the Johnson & Johnson and like the Kraft Heinz, those were doing well. Those were up. So it kind of balanced things out. But now, and at the time I was like, God, why did I buy Meta? I should have bought more Johnson & Johnson. It's up like 12%. Meta's down 50%. The market's down 15%. But now I'm like, thank God I bought Meta. And I didn't go in. So if you want safety, if you can't handle the volatility, if you want safety, just buy like a bond or something, or go into money market funds.
Yeah, you bring up something really important, or something I would want to point out for the community of investors here. So overall, what I would caution investors not to do is, technology is going to maybe not work for the next 6 months, or heck, maybe the next year, so I'm going to get out of it. Well, that might not be a good idea. Scott's referencing Meta, and Meta in 2022 sold off big, and it was just amazing how the market just said, Meta is not worth what it was worth. In fact, we're going to discount it by 76%. That was just like amazing that the market took it that low. Now keep that thought as we look at investing. I would prefer to take a bad year now followed by 4 great years, especially if you're going to give me Meta or a similar investment at a steep discount. Now, how do you do that? Well, if you're dependent on your portfolio, like I need it for my living expenses and so forth, take a percentage of that portfolio and put it into income bonds, things that are going to keep, paying your bills and flowing the cash flow you need. But determine what investor you are, like what industries you're good at. If you're good at picking technology, communication services, whatever industry, don't give up your advantage. Like, hey, I'm really good at picking industrials. Okay, don't give up your advantage. In fact, if a stock is going to be discounted, again, back to Meta, and you know what, Meta's going to come back. Heck, put more money into it. You're going to have a bad year followed by a phenomenal comeback, 439% from the low.
Yeah, it's crazy.
So as we look at these bad moments, right, the NASDAQ is down. Oh, man, it's down for 10%. Well, that's not really that big because it's been up so much. But let's not forget, where is the money going to be over the next 5 years? Look at your horizon. And if it's like, hey, I got this portfolio and there is some money I'm going to need next year or in the next couple of years. Okay, that money should be in safe assets, bonds, cash. Cash is still paying 4 or 5%. Maybe some safe stocks like staples and so forth. but the rest of it where you're like, oh, I don't need that money for 10, 20 years, for the next 10, 20 years, I still think technology is going to outperform. Communication services is going to outperform. Some parts of consumer discretionary are out going to perform. Some of the new companies within industrials and so forth are going to outperform. So let's not give up on our advantages in the market. Let's keep on the investing path that has really been performing well over the last 5 years for us.
Yeah. No, I mean, I myself put a good amount into indexes because as much fun it is to try to find stocks that are undervalued, I think it's really difficult. I don't know I'm not sure if I beat the market overall. I might have been better off putting in everything into S&P 500 and not even looking at the market. So I think if you want exposure to the market, just go into the S&P 500, the Spiders or VOO. And there's so many indexes, ETFs, the fees are so low. Put into the Russell, like the past few weeks, it's up like 10%. So that's a good hedge.
There's certainly like some of the community members, man, they make ETFs work for them. And, if it works for you, great. Use ETFs. I made a decision to get out of ETFs, mutual funds, over 5 years ago completely. And I think the reason for it is if you look at my portfolio, everything in my portfolio.
You probably have kind of an index in yourself or ETF. Well,
I shape it around my family. Like, what is it that I'm trying to accomplish for my family? Like the next 5 years, all that cash flow, like anything my family would need is covered by my bond portfolio and cash. So that's taken care of. But everything else, I'm in technology stocks and companies that I believe in. I'm in, consumer discretionary in companies that I believe in. So you're right that, hey, you know what? If you don't, because I could tell you for a fact that managing this number of stocks takes time, energy, passion, interest. I make mistakes. So you got to be willing to make mistakes and learn from your mistakes.
This is yours?
But at the same time, it's very gratifying when you do figure it out and then you really start seeing a stock really work. So, again, pick the lane you want. Are you going to be a pure stock investor like myself and really tailor your portfolio around your needs or maybe your family's needs, your short-term needs, your long-term, objectives? Because that's what I'm doing. And ETFs, I think, are fine. The one thing I would say from a mentality and psychology perspective, going back to my ETF days, is that it was almost like, do you want to be a player on the field affecting the outcome of the result? Or do you want to kind of be in the owner's box and you really aren't making any decisions? You don't even get to talk to the head coach. The head coach is making decisions down there and the players are playing in the game. And, for a while I'm like, well, I think I could probably pick really good companies. I've got 55 years of, living on earth, over 30 years of professional experience. I have a lot of experience working with companies. And I think I could probably pick some good companies. I'm probably going to make some mistakes. But when you buy the S&P, you're buying the whole lot. You're buying Intel in there. You're buying, some crappy companies. But the big ones are going to, determine the S&P's performance. And frankly, over the last 2 years, you made a logical conclusion, which is the S&P's done really well because those big caps on the top did so well. So anyways, those are some thoughts. I think either way could work. It's which one do you want? Pick your lane and make it work.
Yeah, same thing. I feel like I don't really care what people do with their money. Obviously I don't want people doing things bad with their money, but if you're going to invest in, in bonds, if you just leave it in cash under your bed, it doesn't do whatever you want. It's your decision. You know, and I respect people who lose a lot of money in a stock. You know, you gotta have balls. You take risks, but as long as you learn from it, and you adapt. And some people, I know a lot of people who come into money from inheriting something. They go into the market, and if it goes down at any point, they just jump. They leave. They're like, I'm never investing ever again, as if the market's a problem. But you know, that's how it is. Yeah, it's does anybody on the live stream invest in bonds? 'Cause I don't. I bought a bond once after it expired. I didn't. Maybe I should start looking at them, but I just never.
So one thing, you know, as you said, you know, some people just make money and they put it in savings accounts, CDs, and so forth, and then there's the other extreme, which is, hey, this person buys stocks and cryptos and invest in real estate and stuff. And I had, I'm going to say, an elder kind of mentor member of my community who was really hardworking, really smart guy. And he ended up going into sales management, and he was a really good sales guy. And he made a terrific amount of money in his lifetime, but he was only in CDs. He bought municipal bonds that he didn't have to pay tax on. His rate of return was really low. Now, like, you're right, you know, like, he just wanted that. He picked that lane and he went for it. He made enough money in his life to be very comfortable, and he was also very frugal. But the law of 72, what is the law of 72? If you take 72 and you divide it by your rate of return, that's how often you're going to double your money. So if you're making, in this example here, an 8% rate of return, you will double your, if nothing else is changing, you'll take $100,000 and you'll turn it into $200,000, or you'll take $1 million and you'll turn it into $2 million. Now, why invest in stocks? Is because, as an example, 2023, the rate of return on my growth stocks, you know, was like 30 some odd percent. Well, I'm going to get to 72 quite quickly. I just need 2 or 3 years. The bonds, you know, my rate of return on bonds was 5-6% last year. All right, it's going to take a long time to get to 72. So my intent's not to double my bond portfolio, but that's kind of like what you're giving up. It's risk reward. If you make money and then you put it under a mattress, or you go down to your local bank and say, hey, I just want to buy a CD because I don't want to have the stress of markets going up and down, that's fine. But you're giving up a lot of gains. I'd rather see my money double every 5 years or so. And because I've done it, right? And once you've done it, you're like, well, my expectation of myself is to keep doing it. So I want to keep doubling my money every 5 years or so. All right. So let me turn my attention to micro caps, small caps, mid caps, Dow Jones, S&P, and NASDAQ. I sorted it last month performance. Micro caps were, they took the last month, but they did terrible over the last 3 years. Where NASDAQ ruled the last 3 years, but had the worst month. Any observations there? What do you think about small caps? Are you interested in small caps? Do you think they're going to start working? Because they haven't been working all that great over the last couple of years.
No, I just don't. Yeah, I don't see the value in investing in an index of small caps. I do see the value of maybe picking one or two if you kind of identify a good company. But generally, if you look at like smaller companies, they generally don't perform as well. A lot of them go out of business before they make money or get acquired. Just like a small business, like most people who start small businesses never really, you know, a majority don't make much money and have to go back to a regular job. So, you know, I should probably look at it historically over a longer period of time, but I think the way to go is a proven entity. that's where I made most of my money, is not by picking these gems that no one knew about, just picking good companies and holding them a long time, or potentially getting in at a pullback. But when I bought Berkshire, it wasn't a pullback. It was probably trading close to a 12-time high when I bought it, but it was such a good stock that it more than doubled since I bought it. But I think I like to go with more established big companies, because it's kind of like if you have a friend that wants to borrow $100, or maybe say $1,000, and they don't work, and sometimes they don't pay people back, and they're not the best with money. Like, there's really no benefit of you lending $1,000 to that person, even if they give you interest. But if you have a friend who has a good job, things like that, who always pays people back. Same thing with investing. I'd rather invest in someone that I feel like is competent and has a history of success.
Yeah, I agree with you that it's probably a safer lane to take, which is, Berkshire. Okay, we know Berkshire. We know what they've been about. I would say one exception, right? If you know an industry really, really well, like I've worked in technology for some time, enterprise software, and things that businesses buy and then they use software, hyperscalers. Now, if a new company, a new kid on the block came out with something that the market really needs, and these guys nailed it, that would be the exception on a small cap. Like, hey, I'm buying stock in that company because I have a lot of advantages with knowledge of that industry. I know I have my awareness and so forth. So I don't want to relinquish my advantage in that case there. And of course, I'm going to buy big caps. I'm going to buy mid caps in an industry that I really know and like. So I would say that would be one exception on micro caps, is be very specific on micro caps in small caps on stuff that you really understand and you think is really going to work because you know that industry really well. But just to go out and pick like 10 small caps and expect they're going to perform, I would say some of those small caps are really going to disappoint and probably bring down your return.
It's true. I'm looking right now at the Russell compared to the S&P index. And so the Russell started in August 2017, at least the Russell 2000. And pretty much in any time period. So from 2017, when the Russell started, from 2017 to current, S&P is up 110% and Russell's up 40%.
I'm showing it on the screen, and the Russell just has underperformed the NASDAQ and the S&P. It hasn't really. I mean, I think about in 2021, it was kind of, right there at the S&P. It was actually outperforming the S&P in early 21. But in general, I mean, the separation between the big caps and the small caps over the last couple of years, it's been very clear. You had to be in big caps to get a very good rate of return. So I agree with that. Yeah. So Berkshire is going to announce tomorrow, correct? Or wait, on August 13th, I thought it was tomorrow.
Somebody said that they mentioned that they sold half their Apple. Is it officially tomorrow?
Yeah, they sold. So Buffett sold half his stake in Apple. And what I don't understand is how come Apple is not going down in value? It's like if your most famous stockholder just sold half his position, it's a massive position. He's probably not feeling optimistic about the future. I'm not optimistic about the Apple future. I think their business is not growing. I don't see the catalyst for growth. I think we went over, smartphone sales. They're not the leader. So there's a lot of other companies that provide a phone that's almost as good for 25% of the price of an Apple item. you look at their ideas, they came out with their VR headset. I mean, what was that? $3,500. Who really is going to buy that? That was just a waste of time. They completely folded up their Apple Car idea, which was a dumb idea to begin with. And I think they're behind on the AI, race. They haven't really invested on their own AI where Meta did, Google did, Microsoft is investing, and AWS is the big hyperscaler. So as the big major caps, I'm not excited about the Apple business. And now with Warren Buffett, selling half his stake, I mean, I'm not optimistic Apple's going to do very well going forward.
Yeah. I have a lot of concerns about Apple too. And I guess when the best investor who's ever lived sells half, I guess it should validate my concerns. I mean, I'm still bullish Apple. I wouldn't buy it though. I do own a little bit, but if I had to bet, I think Apple is going to be just fine. But I'm not that confident enough to put my money on it. So I guess I'm kind of on the fence in a sense. But I'm glad he's exiting Apple because he milked that thing beautifully.
What's driving the Apple price is their buybacks are phenomenal. And that's the buyback program that they instituted. Warren Buffett told them to do that. And it really does work because they take shares off the market. But Apple's in the technology space. You're only as good as your technology. That's only going to work for a certain, period of time. And if that iPhone loses, you remember BlackBerry, right? BlackBerry phones were dominant. They had like 83% market share. Apple only has like 40% market share. And it was really hard 20 years ago to ever imagine, there's going to be a world with no BlackBerry. It's like, no way, you're insane for ever even saying that. But guess what? There's no more BlackBerries.
Right.
Very quickly, you had a shift, a migration of people going from BlackBerry to iPhone, as well as other tablet-like smartphones. Mm-hmm. And, Apple can see half their business go away in a few years if Samsung came out with some whiz bang. Like their foldable phone is really impressive, and they come out with some other technology. Like Samsung came out with their AI phone, they were out with it like months ago, and Apple's just getting around to doing it. So I think at one of these paradigm shifts, I think Apple is going to lose a good part of their value.
Yeah, it seems so. They beat revenue, but I think they missed an earnings, right? Second quarter, I can't remember.
You can say that they grew revenue by like 1%.
Yeah, they're not like they're not growing anymore like these other behemoth tech companies. So they have to adapt. I mean, I hope they do well because they are a big part of the S&P 500, and I'm investing in the S&P 500. So that's why, like, sometimes I root against Nvidia, but when they go down a lot, I kind of move with it because they have such pull on these big indexes that I'm invested in. And it seems like when Nvidia goes up, Meta goes up, and when Nvidia goes down, Meta goes down. But I guess that's
good stuff. So hey, let's talk about. I'm going to completely take a left turn here, but one of the community members, he was in early. He wanted to talk about Lumen. So let's talk about Lumen Technologies. This stock, I mean, it's been hammered, but recently you'd be up 189% if you were in the stock. In the last month, you'd be up 189%. Beautiful. But this is a troubled company. Their forward PE is 20. So are things turning around for Lumen?
Yeah. That sounds odd. It could be something They must have had a big gain on their income statement, because they were sub 10 PE for a while, and if you strip out like those non-cash items, because they have a ton of infrastructure, because they build
networks,
like telecom cables. So the problem is their technology is really old. It's not 5G. It's the old telecom. I think copper. They use copper. So they're kind of using an obsolete product. But there's just so much infrastructure out there. You can't just switch it up. It's not like that easy. It's kind of like if Walmart wanted to redesign their retail stores, you just can't do it overnight. It would take literally like a decade. So they
made
really
a little bit of money in their last quarter, and their revenue did not. The revenue went down. It went down about 448 million. So that's a pretty good chunk. That's like their revenue's down 12%, but they did make a little bit of money. They're selling off assets. I know that, so they can prop up their balance sheet.
Yeah, they had a gain on their income statement, I think. But they did have positive operating income, which was. What about cash flow? Are they do they have positive cash flow? So yeah, they're still generating cash.
Yeah.
1.1 billion.
400 million of free cash flow, roughly. So 400 million, and what's their market cap? It's 3.1 billion. So yeah, it's a very risky company, because are they gonna be in business, or are they gonna be bankrupt and then be sold, their assets be sold to other companies? That's the big question. I think their debt is where the big problems lie. Their long-term debt's 18.5 billion. It is down about $1.3 billion. And yeah, so current portion of long-term debt's 86. So they are trying to bring down their debt. And at their current cash flow rate, I mean, if they're cash flowing, let's say $1.52 billion, man, that debt's a big problem. I think the reason the stock rallied is if you got this much debt, and now let's say you're paying 1% less because interest rates did drop really fast, that's a big relief for Lumen. They're like, all right, cool. Our interest expense, which how much is it interest expense on their income statement? Let's take a look. So interest expense, see, $291 million. That's a big number.
See, if it wasn't for that gain of 275 million, they would have had a net loss. The only reason it looks okay because of that $275 million gain on the early retirement of debt. And they also had a gain in other. So those kind of things, analysts know to strip those things out. An analyst knows they have a loss. They are generating positive cash flow because they still have a pretty good number of customers, even though they're
in long-term contracts, and it's hard to switch because it's like if you have your business on their network, it's not like you can snap your fingers and move on to somebody else.
And it probably works. I'm sure that their customers, it works. They've been using them for, this company's been around for almost 100 years, I think. So they might have been using them for 20, 30, 40, 50 years. And it's kind of like when the dial-up modem came, people still use dial-up well into like the cable because people just used to things. They don't switch. Just like I don't want to buy an EV. I'm used to it. I like having a nice car. But they are losing a lot of market share, Lumen, and that's a recipe for disaster. Although if you're a short-term trader, you could have really made a killing. I don't know how you'd know that a dollar was their low point, but and
Lumen's problems are really showing up. But I think if you look at AT&T and if you look at Verizon, their debt levels are just too high. And it's really with the interest rate rise that we saw from, call it 2022, late 2021 to, let's say, late 2022, that's where the balance sheets for AT&T and Verizon just became really undesirable, because high interest rates with high debt level just make this really, really bad. So this company here, I would not touch. It is just way too hot. I don't know. Some people might get lucky. And I mean, congratulations to anybody who saw the opportunity, bought the stock at $1.06 a share, and is now sitting at $3. Congratulations. You deserve every dollar. But this is high risk. It's not something I want to get involved with.
Yeah, these kind of things, this kind of stock, if you can time it, I don't know how you do it besides getting lucky. But you could have made a killing. But I remember talking about this stock for years, like when it was trading. Like when I started my channel, it was trading like 20, 30, and then it goes down to like 15, and it goes down to like 8. It seems like such a good value. Imagine getting at 8, down 50%, and then like, even though it tripled in price, you're still down 60% from 8. So like, 1 was the sweet spot, but don't hold it, because it's going to go right back down to below $1. They'll do a reverse stock split. It can't go up long term. It just can't.
Yeah, that balance sheet's just a giant anchor holding the company down. We'll see what happens. Hopefully they make it. I don't want their employees to lose their jobs, but
I mean, I think there's a chance they could get acquired. Although, that's the only chance they have. And then the who buys them was able to convert some of the customers into like 5G or whatever newer technology that's not going away. But it's going to be hard to find a buyer. Yeah, I don't know how to like. I'm trying to get better at valuing companies that are acquisition targets, and I picked one once. Of course, I didn't invest in it though. I talked about in my video how I said it was a good acquisition, and they did get acquired. But I don't know, like, yeah.
So that's Lumen. There was a question earlier around foreign stocks, and the question was, do I invest in foreign stocks? And the question would be for you as well. And I'll lead off and say, not really. Every time I look to buy a foreign stock, like I was looking to buy Nintendo, it's been a little bit of time since that. All the transaction fees to buy over the counter, because it's a Japanese company traded on Japanese exchange, it just became difficult. And I'm like, well, when I go to sell this stock, I'm probably going to have a hard time selling it for the same reasons. So I'm not a big international stock buyer. If it's traded like Alibaba, I own Alibaba. I own Ternium. I own some companies that are international companies that are traded on the New York Stock Exchange. That once you get to the New York Stock Exchange, I feel more comfortable. I feel there's more accountability. You have to report your financials on a timeline. All those things make me feel more comfortable. So that's why I stick to that recipe for my investments. What about you, Scott? You ever buy foreign stocks?
Yeah, I was just looking at my portfolio. I own one that happens to be my best performing stock. New Holdings, a new bank, the Brazilian fintech. So I just got it at the right time. Kind of got lucky. Let me see.
But like, this one's traded on the New York Stock Exchange, right?
Yeah. I got it at 4.25.
Nice.
And I was up 250%. Now I'm up like 200 something percent. But yeah, that's been doing really well. And I have a Roth IRA that I opened up, and I was kind of like investing a little risky with it, and I lost a lot on doing these different like some of these investments. So I was like, let me put into a stock that's beaten down, that I think has potential. And I picked this, and I'm not going to say like I'm a genius. I think I got lucky, and I just timed it right. Because there's a lot of stocks I have bought that I just took a
I was in
killing on, and I
Stoneco,
sold.
Stoneco, right? I sold my Stoneco position. I did okay. But at some points, like, see how it was nice and high?
Yeah.
I bought low, and then it went really high, and then it came back down. I sold recently. So I did okay because I wanted to concentrate my investment in PayPal, which has been having a couple of nice weeks, which thank God, right? Really strong fundamentals. I really enjoyed your video, by the way. I thought your video was very good on PayPal.
Oh, thank you.
I'm, right there with you on the discount level. I think your discount on the company is similar to mine. PayPal is one of those companies where everybody decided, hey, let's hate PayPal together. And part of it is that, the stock price was way too high. It came back down. And once you burn investors to this level, right, going from $300 a share to $80 a share, I think a lot of people resent you. And I think that's part of it. But at the end of the day, hey, it's just money. And, these guys keep growing. They keep growing their business. They keep getting bigger. Like each year they keep getting bigger, and they make good margins. They create good cash flow. I'm like, okay, the market at some point is going to get over the fact that it used to be a $300 stock, and this is going to begin to rise. And it was good to see that it had a very good rise after their earnings. Hopefully they can keep going. I don't hold this kind of pullback against them because the whole market's pulling back. But PayPal, I think, is going to start working again. And I'm glad I bought those shares. I bought, thinking, hey, I want to buy when nobody likes it, like around these regions. And I tried to buy in the regions where it was really discounted. And now I'm sitting on a small, tiny gain, but hopefully this stock will double over the next couple of years.
Yeah, it's a great company. It's a great business model. But unfortunately, their like Meta went up, 300-400% after its crazy drop, and this company didn't go up, even though it probably should go back up because it's a solid company. It's been around. It has a good customer base. It's still growing. It acquired Venmo, a brilliant acquisition.
Yeah. I don't think there's anybody in the U.S. that doesn't use Venmo.
Yeah, I mean, I use PayPal. I love PayPal. It's convenient. It's kind of part of my life. I'll probably always use it. But Venmo, initially I didn't use it, but then once someone said, "Can I Venmo you?" Now I love it. So they really them and what's it called?
Block.
What's Alibaba?
Alipay.
Them and Alipay are just kind of like control this world. Alipay is bigger because of China, but PayPal, yeah. And then it's the problem is fierce competition. It's so fierce because the barrier to entry is pretty low. It's not that hard to start one of these companies.
Well, the thing that PayPal has, right, is once you go online, right, your brand is so important. And I think if for example, I'm loading a new app and that app says, hey, I'm ABC, I'm the ABC app, and I'm going to do some type of service for you, and I accept payments on PayPal. Okay, I'm comfortable. Why? I've used PayPal for 20 years. I'm comfortable if they use PayPal. But let's say they said, oh, we use XYZ payment method. I'm like, whoa, time out. Wait.
Right.
I'm not going to give you my bank account. I'm not going to give you personal data. I don't know that company. So I think that is one barrier of entry is the brand.
Oh,
the brand is trusted.
Yeah. I think that's the biggest barrier because it's very easy. It's so easy to sell things online. Anybody can do it. I've sold things online, but being an Amazon and having a logistics and warehousing, that's a different world. So you're never going to compete with Amazon. You could sell things online, but you're never going to compete with Amazon. It's like PayPal. Like you can try to develop your own app but you're never going to get that brand recognition. Like it would take decades if you ever even get close to building that brand recognition. That's the real barrier to entry.
And the users, right? Like Venmo, are you going to switch that user base? Like if, let's say Google said, hey, we want to replace Venmo. Okay, good luck. It's going to be very hard to switch people from Venmo to something else. There's just a lot of stickiness because, no, I don't want to switch Venmo. I've been, paying my friends because you go out to dinner, somebody charges it on their credit card and you go, okay, I'll Venmo you my $15 or $30, my portion. Very quickly, you just kind of settle whatever needs to be settled. It's so convenient. And it kind of blows my mind that like I started a business with my wife in 2010. And previous to that, I started a business way back when. And way back when, like to accept credit cards, it was like, God, man, you had to go through paperwork and this and that. And it's like,
true.
Am I going to go work for the State Department? What's the deal here? And then you go to Venmo and you're like, bam, you get signed up, you link your bank, you're ready to go. Next. And I'm like, well, brilliant. Why can't they make the other things that much easier? So they made it really easy. And other companies are coming into the space that make it super easy like that and, and safe. The other part of the PayPal that they're getting into, we'll see how it works, is the buy now, pay later model, which, is like you said, risky. Or I don't know if you said risky earlier. It's just competitive, right? I get the buy now, pay later, but you're only going to be as good as how you can give out the right loans. If you take on too many bad loans, you're going to lose a lot of money.
But I think that alone will make the stock 4, 5, 6x, because when you compare PayPal to others in the industry, their industry, hardly anybody does what they do. PayPal, like a publicly traded company of that size. So the comparisons are Amex, Visa, because those are in the same industry. And it's kind of different. Like what Amex, Visa, what do credit cards do? They provide loans to people. And they don't even want you to pay your loan back. They want you to pay the minimum balance. And they earn 20% sometimes on the interest. So if PayPal is going to do that, and I think they could probably do it better than Visa, Amex. So that business model is very lucrative, and I think
I didn't think of it that way. You bring out a really good point, which is the paradigm of credit cards, right? You buy on a credit card, and then you, like you said, you're kind of a slave to that high interest rate. Well, if PayPal, and I think what's the other company that exclusively does this, buy now, pay later, if they break that paradigm and say, no, don't buy big purchases on your credit card, you would be giving your money away to Visa or MasterCard or whoever underwrites that. I think they could break that paradigm and take a lot of that business away. And pretty soon it'd be like, because you look at Visa, right? The model of Visa started in the 60s, and it was a in-person experience. You provide a card, and then they would remember those physical swipers.
Yeah.
So that was the experience, right? And then we evolved. Now we're fully digital. Well, you put in a number online, and then they transact on Visa, and Visa's like, sweet, we don't even have to like physically give you a card. We just give you a number. Well, the whole buy now, pay later, it really fits the internet quite well, where you're on Amazon and you're like, all right, cool, I want this big TV because football season's coming. It's $2,000. I'll buy now, pay later. Boom. Okay, you just took a transaction away from Visa and you gave it to PayPal or that other company that I forgot their name.
Affirm? Is it Affirm?
Affirm. That's it, Affirm. So that is an opportunity to break a paradigm and somewhat disrupt Visa is with these buy now, pay later programs. So
yeah, no, I think it's brilliant, and this is the only thing that's kind of like separating these credit cards from PayPal is that PayPal doesn't really offer loans, and that's what credit cards do. And who doesn't want to see someone knock off a credit card company? Credit card companies, we don't think of them as these companies that are doing great things in society. We think of them as like
they're right there with attorneys, right? If you ran over a group of attorneys, nobody would shed a tear.
It's true that yeah. What are the
right, cool.
What did Neil say? No ADRs? What's he referring to? The was that from?
Maybe he doesn't own any ADRs.
Was it new bank? Was it from the new bank conversation?
Probably, yeah.
ADRs. ADRs are great because you can buy foreign stocks and not have to worry about conversion because all the dividends, if they do pay a dividend, everything's going to be in US dollars, which is nice. You don't have to deal with taxes.
Because it was hard. Beautiful growth.
Yeah, they're in a good because Brazil is huge. It's such a big country in terms of number of people, and it's a little more up in terms of income levels. It's a little higher than Mexico, even though Mexico is huge as well. But the great thing about Brazil is they really tap into all those South American countries. Yeah, and I think if you're in Argentina or Chile, I think you'd rather do business with Brazilian companies than U.S. companies. I think it's kind of like part of your home. So they just have a lot of people they access. And if only 10% of the people can afford the product, that's still 10% of like, I don't know how many billion people.
Yeah, I think Mexico is like tethered to the U.S., but down in South America, they kind of tether to each other. Colombia is tethered to Brazil, tethered to Argentina, Uruguay. Yeah, I agree with you. Chile. I think they do business internationally, but they kind of do a lot of business, together because they have borders. So they sell to one another.
Keep it on our homeland. I think they kind of South America. I think they kind of feel together. North America is just really U.S. and then Mexico is kind of there. But so it's a good country. It's definitely a lot lower risk than Mexico in terms of geopolitical risk. So I think it's not great. I mean, Germany is much safer than Brazil, of course, but bigger risk, bigger reward, and I was willing to take the risk.
Congratulations.
I hope it might crash, but that's part of the investing, right?
Yeah, it's part of the game. All right, so just to kind of wrap things up, next week, what's your best guess as to are we going to go up or down? What's your feeling about the market next week?
It seems like we're trending down, and momentum kind of is the driver with a lot of things, with the stock market or anything. So there's fear out there. I think some people are looking at some stocks as, okay, finally Nvidia is down. There's a discount. So, but I could see the third quarter being a bad quarter, and then the fourth quarter picking back up. But I try to like look at things on a momentum basis. I'm not going to wait for a bottom point because you wait too long and then you miss the run up. So if you like these, mega caps, you should love them now because a lot of them are down. Nvidia, what's that? It's down 15% in a month.
It's down 20.49.
I was looking at the the percentage. What do you,
I'm looking from the high to the
oh,
low.
20.49. Okay.
Yeah.
That's just for the month or?
But that's
for the month.
since July 10th. If you look at the full month, they're only down 14.75. My observation on the market is I think some stocks are priced much too high, and I felt that way. I've been feeling that way for a couple months. Nvidia being one of them. And if you look at like Super Microcomputer, that's a hardware company. It's a technology hardware company. They should not be valued where Super Microcomputer is priced at. So if you understand hardware companies, they have very little margin. So they could triple their revenue, but you're still not delivering a lot of margin or cash flow. And so I'm shorting Nvidia, I'm shorting Super Micro, because I felt these prices are much, much too high. And if you look at the last monthly, it's down substantially.
They're down 50% from their peak. That's great. I didn't realize they're down so much. You could have been a billionaire if you shorted them.
I don't know about a billionaire. I'm up 22% on that short position.
You'd have to buy a lot of options.
But you would have to let me borrow like $10 billion to make that big bet. Anyway, so the other stocks that I think were just overheated was anything around that data center. For example, Vistra. Vistra is generates electricity, and utility companies, if you asked Vistra, hey, you guys are great, I'd like to buy 3 times as much power from you in a month. The answer is, I can't do that for you. But I can do that for you in about 5 to 10 years once I build the power plants. It's like, well, how can a company that cannot scale up revenue that quickly, their stock price just go freaking nuts, like $20 a share up to $100 a share. So all these stocks were telling me, okay, the market, irrational exuberance, the market's just kind of getting nuts. Like all these stocks are just getting run up. So going into next week, the market also had severe days. You had a day here where the market was down. You look at that drop. That's big. So the rate of the violence in the correction, to me, speaks to hedge funds, really smart money, getting the heck out of the way. And to me means that next week, if there's, and again, we are seeing earnings, 80% of companies have reported positive earnings. So this is more of a correction on price, and it's going to keep going. If we smell any kind of weakness this week, look out. We're going to be down another 5% on the S&P, another 7-8% on the NASDAQ very quickly. Or it could just be down a couple percentage points. And we'll see how things happen. But it is a fun time to operate. Not that I like losing money, because my portfolio certainly went down. But as you look at investments, for example, Amazon dropped to a point where I started buying shares in Amazon, and I picked it up. I'm not a day trader, but rather be lucky than good sometimes. And it dropped, substantially on the day that I think the day after it announced, and I bought in the morning hours, and I bought at, this price, and it went up. I'm up 3.5%. And Amazon's a company that's a great business. I've owned that stock for a long time. I sold it at the end of 23. I regretted it. I'm like, oh man, why did I sell it, you knucklehead? So now I need to build back a position. So as you're right, that as it sells off, some of these quality businesses that I want to be a part of, or maybe even more, like I've been buying Meta, Google, Uber, Airbnb. I mean, those are my usual suspects. I'm buying more and more and more. And I'm buying more of Amazon, and we'll see how things sort themselves out. But I think we're in a period of time where we're not out of this yet. I don't see anything big coming out that's going to say, oh, hallelujah, here's another growth, factor for the market. There's just still a lot of fear. And now that, some of these great companies like Amazon reported good earnings and they went down this much. It's like, what's going on here? So we'll see how it plays out. It'll be very interesting to see. And I'm probably going to live stream. I live streamed 4 times last week because it was so darn interesting. I'm probably going to do the same thing this week because it's probably going to be really interesting. And I'll live stream in the afternoon because I can't do it in the morning. With few exceptions, I'll do it in the morning. But it's probably more interesting in the afternoon because then we're kind of surveying what the heck happened. Like, oh my God, did you see this stock dropped this amount, or this stock did this, or this stock did that? So we'll see how it plays out.
Definitely. Yeah, that sounds good. Yeah. So I hope everybody enjoyed the live stream.
Yeah. Thanks everybody for tuning in. I think we'll shut it down. And Scott, thank you so much for tuning in, for co-hosting the live stream. I really appreciate it. And look forward to doing this again on your channel or mine anytime. You'd let me know. And everybody, thanks for tuning in. Everybody have a nice Sunday afternoon and good luck with your investments next week.
Okay. Yep. See ya. Thanks.
Right. We'll see you, Scott.
Okay. Bye.